Hello everyone and welcome back to Explain the Charts, your go-to channel for detailed market analysis. Today is October 5th, 2025, and we're turning our focus to USDCAD, a pair that's generating a lot of buzz as it trades near significant highs. Before we jump into the charts, let's cover the fundamental landscape, because the news is painting a very clear picture right now. The primary driver is a stark divergence in monetary policy between the Bank of Canada and the U.S. Federal Reserve. The BC has been in an easing cycle, cutting interest rates to a three-year low in September, with the market pricing in at least one more cut before the end of the year. This dovish stance from the BC is largely due to a weakening Canadian employment report. Conversely, in the United States, recent strong labor market data, like low jobless claims, has the Fed sounding more hawkish. While the Fed has initiated some cuts, persistent economic strength could mean they pause or slow down their easing, which is bullish for the US dollar. This growing interest rate differential between the two nations puts fundamental upward pressure on the USDCAD pair. Adding to this are political factors. Late 2024 saw a political crisis in Canada, leading to a weakened minority government and creating market uncertainty. Meanwhile, the potential return of Donald Trump to the White House is seen by some analysts as a net positive for U.S. financial markets, further strengthening the dollar's appeal. Most analyst forecasts reflect this bullish sentiment, with some pointing to a potential technical ceiling near the 1.4400 level. However, it's not a one-way street, as some long-term forecasts from institutions like UBS see the pair falling back to 1.3300 by the end of 2025, suggesting potential headwinds. So with that context, let's see how this narrative is reflected in the price action on our charts. Here on the daily chart, we can see the broader uptrend that has been in place for most of the year. The price has climbed significantly from the lows we saw around 1.3721 in August, which now acts as a key long-term support level. This entire move up has been quite persistent, forming a clear ascending channel pattern, which is a classic sign of a healthy uptrend. The price has recently been challenging the upper boundaries of this channel, reaching a 5-month high just shy of the 1.4000 psychological level. We saw a high of 1.3986 just a few days ago, which is a critical resistance point to watch. Let's zoom in on the price action since August to get a clearer view of this recent leg up. In this focused view, you can clearly see the breakout above the previous August high around 1.3925. After breaking out, the price pulled back to retest this area, which is classic technical behavior where prior resistance becomes new support. That pullback lines up perfectly with news of U.S. government shutdown fears and quarter-end flows, which caused a temporary dip in the dollar. However, buyers stepped in right at that key trend line and the 1.39 level, showing strong demand in this zone. The price is now consolidating just below the recent highs, coiling for its next potential move. The prevailing bias remains bullish as long as we hold above this support zone around 1.3900 to 1.3925. A significant support level below that is the lower boundary of the ascending channel, currently sitting around 1.3880. A break below 1.3880 would be the first major warning sign for the bulls. Now let's switch to a lower time frame to analyze the current consolidation in more detail. On the 1-hour chart, we can see the price action of the last few weeks. Here is the push up to the 1.3986 high, followed by that pullback we just discussed. Notice how the price formed a minor downward trend line during that correction. However, in late September, the price decisively broke above that short-term downtrend, signaling that buyers were retaking control. Since then, the price has been making a series of higher lows, which is constructive for the bullish case. We are currently trading in a tight range between roughly 1.3938 and 1.3968. This sideways movement suggests the market is pausing to digest the recent gains and is waiting for a new catalyst. This catalyst could very well be the upcoming U.S. non-farm payrolls report, which will be critical for the Fed's next move. Let's zoom in one last time to the 15-minute chart to see the very immediate price action. Here on the 15-minute chart, you can see the tight consolidation range very clearly. For intraday traders, These are the key levels to watch right now. The local resistance is the zone between 1.3960 and 1.3970, and support is holding around 1.3940. A breakout above this range could signal a continuation of the uptrend and a retest of the 1.3986 highs. Conversely, a break below 1.3938 could see price drift down to test the next support level around 1.3900. The low volume in recent hours confirms this period of indecision ahead of major economic data. Now, let's go back to the daily chart to recap and put everything together. So, to summarize what we are seeing across the board, the fundamental picture strongly favors a higher USDCAD due to the diverging policies of the Bank of Canada and the Federal Reserve. The technical picture on the daily chart is a clear uptrend, currently consolidating after a strong breakout. Let's recap the critical price levels. Immediate resistance is at the recent high of 1.3986. Above that, the major hurdle is the psychological 1.4000 mark and the 5-month high at 1.4016. A decisive close above 1.4020 would be a very strong bullish confirmation, opening the door to targets at 1.4100 and potentially the longer-term analyst target near 1.4400. On the downside, initial support is at the 1.3925 pivot area, followed by the crucial ascending channel support around 1.3880. If that level breaks, the bullish bias weakens, and we could see a deeper correction towards the 50-day EMA around 1.3814, and then the major support at 1.3721. So, here are the potential scenarios. The bullish scenario, which I believe has about a 65% probability, is that the price breaks above 1.4020 in the coming days or weeks. This would be reinforced by strong U.S. economic data, particularly the upcoming NFP report and any further dovish comments from the Bank of Canada. The bearish scenario, with about a 35% probability, would involve a rejection from the 1.4000 resistance area and a break below the 1.3880 channel support. This could be triggered by surprisingly weak U.S. data, causing traders to reevaluate the Fed's hawkish stance or a sudden positive shock for the Canadian economy. The main thing to look for this week is the U.S. jobs data. It will likely be the catalyst that breaks the current consolidation. Thank you for watching this detailed analysis on Explain the Charts. Remember to like and subscribe for more content like this. And as always, please be aware that this is for informational purposes only and is not financial advice. You should always conduct your own research and analysis before making any investment decisions. Trading involves significant risk, and you should never invest more than you are willing to lose.